Stock market corrections, volatility, and drawdowns. What does it really mean when the market suddenly dropped 10%? Why do corrections happen so often? And should you be afraid of them? If you've ever watched your portfolio dip and felt your heart skip a beat, you're not alone. Today, we're talking about stock market volatility and corrections, why they happen, how often they happen, how long they last, and why understanding them matters for every investor, whether you're 25 or approaching retirement. We'll also talk about common investor mistakes during corrections, how panic can drive irrational decisions, the idea of investing at all-time highs, and why having a diversified portfolio and solid financial plan is so important. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help you reach your goal. If you're new here, please subscribe and click the like button. What is market volatility? At its core, volatility is simply how much and how quickly the market's value goes up and down. Stocks don't move in straight lines. They bounce around all the time. That's volatility in action. There's a lot of things that can cause volatility. Economic data releases, corporate earnings, geopolitical events, interest rate changes, even investor psychology and news headlines. When people hear about volatile markets, they often think this is unusual, but it isn't. Volatility is normal. Understanding that helps you separate market noise from what matters for your long-term goals. What is a market correction? A market correction occurs when a major index, like the S&P 500, drops 10% or more from its most recent peak. It's often described as a pullback in prices. A correction is different from a pullback, usually a smaller 5% drop, and a bear market, a decline of 20% or more from its recent peak. Importantly, corrections happen often. Historically, markets have seen 10% plus corrections roughly once every 1 to 2 years. They are a part of a normal cycle of markets, not an anomaly. Historical frequency and duration. So how long do corrections last? Historical data suggests many corrections reach their low points in about 3 to 6 months. Full recovery back to previous highs can take several months or more. Bear markets, those deeper than 20% plus declines, happen less often, historically maybe every 4 to 7 years or so, and tend to last longer before hitting the bottom. But remember, while these numbers are historical averages, each correction is different. Why corrections happen? Corrections can be triggered by many factors. Stretched valuations or high investor enthusiasm, disappointing economic or corporate data, geopolitical events such as wars, rising interest rates or inflation concern, or shifts in investor sentiment. Even positive fundamentals can trigger volatility if investors were anticipating even better news and it doesn't materialize. Common mistakes investors make during corrections. Now let's talk about behavior, because this is where many investors get into trouble. When a market drops, panic selling often kicks in. People sell out of fear, hoping to avoid more losses. Others try to time the market, waiting to buy at the bottom, but timing the exact bottom is nearly impossible. Some fall prey to herding behavior, when they do what everyone else is doing instead of doing what's appropriate for their goals. Emotion-driven decisions, fear and regret often lead to locking in losses and missing an eventual market rebound. History shows us something important. Over time, markets trend higher despite frequent pullbacks. Investing at all-time highs. One idea that makes investors nervous is buying at all-time highs, when the markets seem expensive and vulnerable to pullbacks. Here's what history tells us. All-time highs are normal and healthy markets. Investing at a high point has historically still produced strong long-term returns, often similar to or even above average returns from other entry points. The fear that markets always fall after a high is largely psychological, more about emotion than math. The real key is time in the market, not trying to perfectly time when you enter. A reminder for those nearing or in retirement. If you're approaching retirement or you're already there, market volatility matters differently. For young investors with decades before retirement, riding out corrections in a stock-heavy portfolio makes sense. But for those closer to or in retirement, your personal investment portfolio should not be only in the stock market. A diversified portfolio that includes bonds, cash, and other non-equity investments helps reduce the risk of having to sell at a low point. Too much concentration risk, whether in stocks, a sector, or a single company, can jeopardize your plan when volatility hits. A well-designed financial plan should give you a clear idea of how much volatility you can actually handle, not just feel you can handle. The big takeaway: stock market volatility, including corrections, is normal. Markets go up and down, sometimes sharply, often unpredictably. But history can also show us that corrections are frequent and usually temporary. Bear markets are deeper but less common. Emotional reactions often cost investors more than the correction itself. Timing the market beats timing the market. Most importantly, having a diversified portfolio and a sound financial plan tailored to your goals and risk tolerance helps you stay on track, no matter what headlines are driving fear today. If you found this helpful, hit the like and subscribe button. Leave a comment with your questions about volatility and market corrections.